Dish Network Corp's Chairman Charlie Ergen sees a narrow window to address the company's capital structure, which includes $14.7 billion of distressed debt that has been sliding further into troubled territory for the past few months. Ergen told analysts during an earnings call Monday that the debt market is challenging and effectively closed to the company. That has Dish considering assets, particularly airwave licenses, as either collateral on new loans or some other option to help it handle its debt. And some kinds of were going well for 77, a public in concept 1 mile paper. We'll take in a break in this operation on New Tampa 77 in the debt, the largest among U.S. issuers, now trades at levels of 1,000 basis points above the benchmark rate. According to data compiled by Bloomberg, the company has $20.4 billion of long-term debt as of March 31st. Our regulatory filing shows. And the satellite TV company, which has been losing subscribers for a decade, has started a costly transition to become a wireless broadband provider in an attempt to find new growth. And this pivot has left the company facing a challenging market to find additional financing. And Dish is also reeling from the impact of a cybersecurity attack in February that disrupted its payment system. Since then, bonds of the company have been in a vortex, and CreditSights senior analyst David C. Hebert wrote in a note Monday that Dish's July 2026 notes have fallen nearly 31 cents on the dollar since early February, while its 7.375% notes due July 2028 have fallen almost 28 cents same period. With Dish needing additional capital and debt maturities next year, we need to see a major step change in the level of cash burn to get comfortable with the background wireless side of the business on Hebert Row. A representative for Dish didn't respond to requests for comment. Dish shares oscillated between gains and losses on Monday after the company reported first quarter results that lagged analyst estimates. Its July 2026 notes fell less than 1 cent to 52 cents, while its July 2028 notes were unchanged as of 2:10 p.m. New York time. According to price reporting system Trice, heavily indebted companies have been attempting to restructure their debt modes with varying degrees of success. WeWork Inc. saw an 86% participation rate for its debt swap, while Carvana Co-Skills extended its deadline twice and sweetened deal terms for bondholders. The path forward for Dish is less clear, with S&P Global Ratings analysts writing in a late April note that the company's capital may be unsustainable long-term given high rates and refinancing requirements next year. S&P analysts expect that Dish will need up to $16 billion in new capital between 2024 and 2026 to fund capital spending, wireless costs, and address upcoming debt maturities. Dish's last debt issuance was in January when it upsized its deal and sold $1.5 billion in notes due 2027 with a hefty coupon of 11.75%. Those notes last traded hands at 93.2 cents on the dollar as of 2:10 p.m. New York time, according to Trace. Credit markets have grown even warier of Dish in recent months. The cost to insure against default in 5 years for the company's senior debt has surged to 48 points up front, meaning it would cost $4.8 million to insure a $10 million